When we think about safe investments, we often look at brands we see every day, right? The ones in our kitchen, the ones our parents used. We think, hey, that's a buy and forget stock. But what if that's a massive trap? Today, we're going to put that very idea to the test by taking a hard look at TTK Prestige.
Yeah, that's what we're talking about today. TTK Prestige. The idea that just because a brand is familiar, it's automatically a safe investment? Well, that's exactly the kind of lazy thinking that can get investors into a lot of trouble. So our mission here is simple: to separate the brand we all know and trust from the actual business we might be investing in.
All right, let's get into it. We're going to treat this like a proper institutional-grade dossier. First, we'll tackle the common perception, then we'll really test its brand power. After that, we'll hit the financial reality check, analyze its competitive defenses, or lack thereof, pinpoint the real risks, and then, finally, deliver the verdict. Okay, Section 1, the big misconception. The story you always hear is that TTK Prestige is this super safe, super reliable, buy and forget kind of stock. I mean, it's the pressure cooker company that's been around forever, right? And because of that feeling, it often trades at a pretty high PE ratio. But that's a dangerous assumption to make. So the perception is, oh, it's just about pressure cookers. But the reality couldn't be more different. TTK is a full-blown kitchen ecosystem brand. And you know what? The kitchen is not a one-time purchase category anymore. It's a battleground of constant upgrades, replacements, and shiny new gadgets. This is a repeat consumption game, and that means one thing: constant, brutal competition. Now, here's where it gets really interesting. Does this powerful, well-known brand actually translate into real business strength? This brings us to what I think is the most dangerous assumption in all of consumer investing: that a strong brand automatically means you have pricing power. And this right here is the absolute core question. I mean, think about it. If the answer is yes, you've got yourself a real, durable moat. But if the answer is no, then what you have is a distribution-led business that is always vulnerable to price wars. The answer to this one question separates the truly great businesses from the merely good ones. This slide just illustrates the problem perfectly. When you're buying luxury goods, you're paying for a story, for aspiration. But in the kitchen, your decision-making is totally different. It's driven by practical things: safety, durability, and, crucially, price. So, yeah, the brand matters, but it only matters within a pretty tight price band. And that severely limits how much TTK can ever hope to charge. So the key takeaway here is this: TTK's brand strength is built on trust, not aspiration. As you can see from this scorecard, its real advantage is its massive distribution moat. But look at the other lines. Its pricing power is just moderate, and the risk from online disruption, high. It's really a distribution company with a trusted brand, not some premium brand with a monopoly. Okay, let's pivot to the financials. It's time to see if the numbers actually back up this story of a flawless, unstoppable compounder, or if they reveal a completely different reality. Let's look at the hard numbers. Historically, TTK's return on capital employed, the ROCE, was fantastic, consistently above 25%. That's a true hallmark of a great business. But as you can see from this trend, that strength is fading fast. Over the last 3 years, ROCE has been squeezed down to around 20%, and it's even lower in recent quarters. Now, this isn't just a blip. It's a flashing red warning signal that the company's competitive edge is being seriously eroded. And this scorecard really confirms where the pressure points are. I mean, the company is healthy in some ways, don't get me wrong. Cash conversion is still strong, and its debt-to-equity ratio is very low, which is great to see. But the cracks really start to show up in growth and profitability. The 3-year sales growth is stuck in the single digits. That's a major slowdown. And its operating margins have been under constant, relentless pressure. This is just not a flawless compounder. It's a mature business that's facing some very real headwinds. So, if the brand isn't this ironclad moat we thought it was, and the financials are showing clear signs of strain, then what exactly is defending this business from the competition? Is its advantage built on solid rock, or is it built on sand? Well, the reality is a multi-front war. TTK is fighting direct rivals like Hawkins, appliance giants like Philips, literally thousands of local players in the unorganized sector, and of course, the constant threat of online price transparency. There are no regulatory shields here, no switching costs to lock customers in. It is just pure head-to-head competition. And this scorecard really confirms what we've been finding. The moat is what we call a soft moat. It's built on two pillars: strong brand trust and a powerful distribution network. But with pretty weak pricing power and incredibly high competition, this is just not a deep, unbreachable fortress, not by a long shot.
So now we have to understand the real existential risks. You see, consumer brands, they rarely just collapse overnight. They die a slow death, a death by 1,000 cuts, from a few key factors that we're going to call kill switches.
These are the three biggest threats, the kill switches for TTK. First, a constant price war from online and local players that just squeezes margins to death. Second, e-commerce directly attacks TTK's biggest advantage, its traditional dealer network. And third, the constant need for discounting slowly erodes the brand, shifting its perception from one of quality to one of, well, just being cheap. These are deep, structural risks that can permanently damage the business. So, after this whole investigation, after stripping away all the assumptions and just looking at the cold, hard facts, what is the final verdict on TTK Prestige as a long-term, high-conviction investment?
And this is probably the most important lesson today. As investors, we have to be absolutely ruthless in telling the difference between a company we like and a business that can actually durably compound our capital over time. A good business? Sure, it has a trusted brand, decent cash flow, but an investable business has a strong moat, real pricing power, and durable growth. They are not the same thing.
Based on all the evidence we've just gone through, for a large, long-term capital allocation, the verdict from this dossier is crystal clear. It's a rejection. And here's exactly why. The pricing power is weak, there is no strong, durable moat to protect it, the competition is intense, and it's never going away, its growth profile is inconsistent at best, and it's fundamentally vulnerable to online disruption. The business simply doesn't meet the high bar for an elite compounder. It's a good company, sure, but it's in a really tough industry.
The key takeaway from all of this is to avoid this trap. Familiarity does not equal safety. Seeing a product in your kitchen every day does not automatically make it a great long-term investment. That kind of thinking is just lazy analysis, and honestly, it's where most investors get themselves into trouble.
So this deep dive into TTK Prestige is really a model for critical thinking, and it makes you wonder, doesn't it? It's worth asking yourself, what other comfortable assumptions, what other safe stocks are hiding similar risks in your own portfolio? Which one of your holdings really needs a reality check?